All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt here with John Martfeld and Lee Mackey.
Good morning, everyone.
Had a fun event yesterday, first annual Next Gen Charity Golf Classic out at Shadow Valley. So that was a lot of fun, raised some money for charities, had a lot of fun with friends and clients and people in the community. So
and next year we're going to do it again. So anybody out there listening that wants to join in,
yeah. We're going to do
like to make it bigger.
Even bigger and better. This was our first year, and I thought it was a great event. So it was a lot of fun. Everybody's coming in kind of a little extra tired.
Eyes are a little swollen from the massive amount of pollen that is in the air right now.
Yeah.
It was a good day.
It was. So real quick, I wanted to start with where we're at year to date. So kind of talking about what's working, what's not. So I'm going to run through some numbers. Asset class returns 2025. So this is year to date as of the close yesterday. So the best performing asset class for this year, international stocks up 12%. So you've got international stocks up 12, commodities up 6.5, emerging stocks up 4, tips up 4, bonds up 3, cash up 1.3, and then everything else is negative. REITs down a little over 0.5%, U.S. large cap down 6, U.S. mid cap down 8.5, and U.S. small cap down a little over 12.5. So it's been a long time since we've seen international stocks working. A lot of clients, I know have asked themselves, not just clients of ours, but anyone invested that's in a, maybe a model portfolio or, is broadly diversified. It's like, well, why the heck do we still have this international exposure? Because it seems like it's been forever that's worked, but this is why you have it, because there's going to be periods where it's working and maybe, U.S. stocks aren't working as well as they have historically. So, and then breaking it down by sector, if you looked at, you look at sectors here in the U.S., staples and utilities are up both around 5%. Healthcare's up 1.2%. Real estate's up 1%. Financials are basically flat. Then materials, industrials, and energy are down 1% to 2%. S&P 500 is down about 6%. And the two, leading the way, not surprising, are tech and discretionary, both down 12% or more. So, when nothing huge, revolutionary I want to get into here, other than just saying, like, when you get into a softening period, the economy softening, people are talking about recessions and negative GDP forecasts and all of that, which we're going to get our first quarter here in the next few days.
Next day.
This is what you would kind of expect. Staples, utilities are working. Healthcare looks pretty decent. Consumer communication services, tech, and discretionary are the worst performing sectors. So, kind of textbook.
It's like a shift.
How you draw. Yeah, I mean, it's exactly what you would expect in this kind of environment. So
it's interesting, and we've all been in this business for a while, and we've all been trained on diversification and modern portfolio theory, and but we have just gone through a period of, what do you think, 10 years
more
where the 60-40 portfolio didn't work.
15 years of that not working.
And for those advisors and firms that, really believed in it, they significantly underperformed these high beta, high growth, companies. And then on a dime, it turned to where you want fixed income, you want international, you want everything.
Maybe some active management.
Yes, and it's interesting that the high-flying, high-beta, high-growth companies are the ones that are doing the worst. And that's to be expected at some point. And then what's doing well is your bread and butter. I tell folks, boring, kind of companies that strong balance sheets, good cash flow, pay dividends, consumer staples, the things that you're going to need regardless of what the economy does.
Well, in my career, I've heard the statement that we're in a new normal many times, right? Oh, it's a new market. This is totally different, completely different. Every time I hear that, I kind of chuckle and think, yeah, until it's not, right? The market repeats itself continuously through our life, even if we have a long extended time frame where it really didn't work. The 60-40 model did not work for 15 years because bonds were held down because of interest rates, and they did not work. in the portfolio. But to say that was never going to come back, or to say international
Right.
stocks were always going to be, is kind of, we know that's not accurate. It does revert, even if it takes a long time. And this particular trend was based on a financial crisis that was magnificently incredible, and then COVID that lowered the rates even more. Just stuff that happens that is once in 100-year type stuff that just happened to happen the last 15 years.
Well, patience is I mean, it's hard in any
It's hard.
aspect of your life, but investing, right? Especially when a trend can go on for 10, 15 years, right? You might, if you're saying something and you're 7 years into it and it's still true,
Yeah.
you're like, you know what? I think we were right. Like, I don't think it's ever going to go back.
Right.
Right. And so it's hard to accept that may not be true when you might be right for 10 or 15 years.
I know. I
Or
wonder
wrong for 10 or 15 years.
Yeah.
You start second guessing yourself. If you were saying the opposite of like, no, this is going to go back, and then you're 10 or 15 years in, I mean, it's tough to stick with that year after year after year.
It is. And I look, a lot of advisors, I don't know what the average right now age or, years of service an average advisor has, but I could start to see a lot of advisors have never experienced a 60-40 model working.
Sure.
Right. So, I mean, I can see a lot of advisors just sticking their flag in the ground saying, no, it's those old guys that talk about that stuff. That's ancient history.
Yeah.
It's never going to come back. And then, you get a wake up call with this stuff. But I mean, it's not stuff we can't navigate, right? It's all part of our plan. Our models are set up that way, and so on to be adjusted as we go, not to always stick in one. And I think that's a smart way to invest, is not always think it's going to be exactly the same forever, but try to move with the market as you're going, which is anyway.
Yeah. So John, you've got some stuff on inflation.
I just thought this was an interesting. This came across my desk the other day, and I just thought this was interesting. The consumer price index is 13% higher today than it would have been if inflation had stayed at its pre-COVID trend of about 1.8% per year. That's a long sentence. But what that means is, like, COVID exasperated inflation, right? We all know that. Mm-hmm. But if COVID didn't happen, in theory, and the market kept going as it was going, if things today cost 13% more than they would have had it happen. And I think that's something we get lost when we listen to these numbers. We're talking about when the Fed should lower rates and should we get in. Lee, we've had this conversation. You've said all the time it's not going to get back down to that 2% target that they keep dreaming of. But even as it slips down, gets in the twos and gets closer, you have to remember that everybody's paying 13% more for goods and services today than they should be if we did not have the COVID thing that kind of ruined everything, right? And I thought that was interesting because we talk about that. It's not like, and every time I hear the inflation information and everybody's like, oh, it's cooling and things are going to be great again. It's still more expensive today than just 5 years ago.
Yeah.
And this
crazy.
is what we've seen historically. I'm trying to pull up a chart here real quick, but let's say the long-term average 100-year inflation average is 3%. It's give or take 3,
Right.
maybe a little higher than 3.1, something like that. That is not a steady 3% over the last 100 years. There are periods where it's been lower than that, and then we have these kind of shocks to the system where we've seen much higher levels of inflation. And so a lot of times I think you can look back and say, like, it shouldn't be surprising.
No.
And I've said this on this podcast before, but that we had 10 or 15 years of low inflation relative to the average, that, the getting back to average was probably not going to be this, like, okay, we're going to just slowly inch our way. It was probably going to be some kind of shock where we go through this shorter term period of much higher than the average inflation, just like you saw back in the 70s. And like you can go back and look at other points in time where inflation rates on a year-over-year basis were much, much higher than the long-term average.
Right.
That's just how it works. It's a lot like the market, right? The market might average 12% a year, but that doesn't come
It never
in the
makes
form
12%. Yeah.
That doesn't come in the form of like 10% this year, 14% next year, 9%, 15%. It comes in, negative 20, positive 35.
Yeah.
And it's volatile, and it's super interesting. I don't think it should be all that surprising. And now, all that said, it stinks because we have set a new base for things are just more expensive.
Yeah.
They're not going to come back down. Hopefully the acceleration from here can kind of stay on the path that we're on in the,
And I think it hurts the 30 and unders, the 35 and unders more than it, like the folks that kind of have been through, Lee, you and I have been through many different times of markets, right? And inflations and costs and so on. This particular one kind of prices. I've seen things about how it's pricing young people out of getting homes. For example, homes have gone up so much. We can see that in Northwest Arkansas, and it's part of that inflation. I thought this was also interesting. The Great Depression where Congress created the FDIC insurance, right? Mm-hmm. Initially, the initial level per account. Can you guys guess what it was?
5,000.
It was 2,500.
Wow.
So that was the initial. In 2008, we upped it to 250,000. If we went by the M2 measure money supply, I'm not going to get into how I came up with this calculation. It actually should be up to 750,000 now, if you go by money on the street, and that's based on how they did it before. But that is an inflation story as well, right? But that's 100 years ago, 2,500. Now we're at 250,000. Should be higher. But to Matt's point, inflation's been there forever. I only think that 13% higher in the last 5 years. My only point to that is, it is affecting our younger people. It's affecting our pocketbooks now,
100%.
even though it did just get us back to the.
And I don't say that to belittle. I mean, it stinks.
No, yeah.
It's hard.
Stinks,
In the moment, it's hard for people because typically wages for a lot of people don't immediately adjust, right? You have to absorb that, and hopefully wages can over time, kind of adjust to that for, whatever situation you find yourself in. But I don't mean to belittle that, but I'm looking at this inflation chart here, and going back to 1914, which I didn't even know dates went back that far, but the 110-year average is 3.27%. And you look at the year-over-year numbers here, right? There's many, many, many years where our inflation is like 1-2 negative percent, and then you see these bursts of like back-to-back 9 years or back-to-back 7, 8, 9, 12% years, 12%, 13%, and then it falls back down and it's 2%, right? And so we just experienced a little bit of that year over year. Hey, that was tough. Yep. That was a shock to prices. But
I wonder how many don't count. But it would be interesting to see how many years over the course of the last 110 actually were 3%.
3%?
3.5. I mean,
right.
To your point.
There's not very many.
To your point. It's an interesting environment right now. I typically counterbalance your sometimes perceived pessimism with my perceived optimism.
Right.
It's a real thing right now. I mean, inflation and the general high cost to live. I mean, from gas is about the only thing, if you can kind of look around, that's down. The price to fill up your tank. Food, clothes, entertainment. And then you throw on now, which we don't even hear about anymore, is student loan repayments.
Oh yeah,
are now really kicking in.
Yeah,
I mean, there are young adults that haven't had to make a student loan payment in 5 years, 6 years. Minimum payments are at an all-time high with credit cards. And so a lot of the things that you have been saying are now really beginning to be felt in the economy. It'll be very interesting. And so, and this may lead into another topic, but there is a lot of negativity in the marketplace right now.
Yeah.
From, investment firms, asset management firms, calling, predicting a recession over the summer, to, empty store shelves, to, mass layoffs in the retail and trucking industries, and the list goes on and on and on.
Yep.
But that doesn't always, to your point, Matt, that doesn't always coincide with a pullback in the markets.
Right.
At the same time.
Well,
okay.
Real quick, and as we've all experienced, like what's staring at you in the face is not typically it's almost like this is the most predictable recession ever that everyone's talking about,
Sure.
right? Because everyone's talking about it. It's it's coming.
It's been on the table for a long time. Yeah.
It's coming, and it almost feels too easy.
Yeah.
It almost feels too easy to predict. I'm not saying that doesn't mean it's not going to happen, or that, but like I think what I'm trying to say by that is, if we experience a softening in the economy, it's less likely to be some massive, catastrophic 2008 type of recession, because
You do or do not?
I believe it's less likely to be that, because it's staring at us in the face. Everyone, quote unquote, knows it's coming.
Yeah.
The pessimism is there. Market sentiment is at historical. I mean, if you look at market sentiment, I have this chart pulled up. Feelings about the U.S. economy. So this is from the University of Michigan Consumer Sentiment Index. Going back to the 1970s, so since 1978, there have only been 4 other points through that entire period where market sentiment was lower than it is today.
Yeah.
Right? And so the fear is there. Everyone's talking about it. It doesn't mean it's not going to happen, but I think it does mean that a lot of people, investors, companies are preparing themselves for it. And so, it's not going to be this shock unless there's something out of left field that no one's talking about.
2 things on that. First of all, when I hear logistics is cutting, and they're worried about the stuff, that really scares me, because logistics is our shipping and our, that's our orders. That if that's going down, that means that orders are going down, spending is going down, and so on. That actually is an alarm bell to me. But going back to President Reagan, when he took over the office he won the election in 1980, took over in 1981. The day after the election, I've said this on the podcast before, but the day after the election, the market went up like it did after Trump got elected. Mm-hmm. It went up the next day, real high. And then for the next 2 years, it was a bad market. And the reason it was bad is because it was a 180-degree change in everything when Reagan took over for Carter. And Trump comes in and takes over for Biden, and what have we noticed? It's a 180-degree change, right? Everything that he's doing is opposite of what President Joe Biden was doing. So whether that's good or bad, I'm not even going to get political about it. When you create that type of change,
sure,
and you do it rapidly, which he's doing, and you bring in, you kind of get other countries angry at you, and the world media and the national media is against you, and it's like every story is kind of compounding on negative. I can understand how the anxiety and fear, even for those that are supporting Trump and what he's doing, I can see how that can build up pretty dramatically and fast, and it can create that issue. My hope is that everything that we're doing right now, like cutting a deficit, trying to cut deficit, getting fairer trade deals, not as big and bold as Trump is saying, but somewhere in between, which is what I think will happen. Hopefully, a year or so from now, we'll make the economy stronger than it was when we started this. Does that make sense?
Sure.
But I think between now and then, it could be a wild ride. And I'm not one to think it's. I actually, think that we're heading towards probably a recession. I'm on the side of that. But the other thing that you were getting across that last point, Matt, the markets are forward-looking always.
Right.
They have already priced in a lot of this stuff. Not all of it has been priced in, of course, because like you said, there could be outliers, but the market is priced in. So I don't think the threat of the recession and the economy is necessarily going to, just be one-to-one comparison to the market and how the market moves.
Right.
The market might have already suffered some of that loss, if that makes sense.
Yeah. I mean, when you look at what S&P 500 earnings, the price historically, normally bottoms before earnings bottom, right? Typically, the market bottoms before the economy bottoms. And so a lot of these things that are yet to come, potentially,
right,
economically, from an earnings perspective, it doesn't mean the market's going to continue to grind lower. Now, we've seen a little bit of a bounce here with the market, right? I mean, we are well off of the lows where we were at a month or so ago. And so it'll be interesting to see, does the market want to try to go back and retest those lows, or is the low in, as they might say. But just because you hear things economically that all the predictions are those are going to get worse, it doesn't mean the market's going to track that same trajectory.
Yes.
Right. And
Exactly.
the same timing. So,
and one final comment on this, at least for me, so much of this mess that we're in right now seems to be man-made, almost self-inflicted. It wasn't, 4 months ago, there wasn't a whole lot wrong with the economy. Pretty strong. And so I fall in the camp of, so much of this was self-inflicted by the administration wanting to, roll out these tariffs. Now, not to say that the economy wouldn't have softened anyway. It was probably time. But it threw the entire world into this state of disarray and, not knowing anything. And so, to me, that gives me a little bit of hope in that, just like it was self-inflicted on the downside, all it would take is that same person to make a different announcement.
well, it's self-inflicted in a way though, because like in a good way, because we're trying to better position ourselves
Yes.
in other areas.
Yes.
Right. And so it's not like, hey, the economy is weaker than it was 6 months ago or softer than it was 6 months ago because of, something bad happening or something. I mean, it's like, it's whether you agree with it or not, like, or you think it's going to work or not, it's a lot of it's because we're trying to better position ourselves in other ways that I think could potentially set us up for the better longer term. And if that means the economy's got to slow down in the interim and it's got to, we've got to take a breather, then it's
switching from Keynes thinking into Milton Friedman thinking. And if you think of that, Milton Friedman is all
Sure.
about capitalism and
Sure, yeah.
markets determining markets, not governments determining markets, which is
Right.
the Keynes. And it literally is switching from that to the other. And that is a 180-degree switch.
Yeah.
But this is what I would say, and I've said this for a long time. Regardless who wins the election, who's president, who's in Congress, all that kind of stuff, I think they have let us down in Washington for a long time, and we've gotten ourselves in this massive hole of debt, right? The trillions of debt we talk about all the time that we can barely service with our tax receipts,
Right.
just the interest anymore. I mean, it's out of control.
yeah.
So that has to get into control, right?
Right.
So one way or the other, and it's going to take a lot of pain.
We can't
to get that into
forever
control.
mask over the true underlying issues.
Yeah.
Because they would have eventually blown up in our face at some point.
Absolutely.
And
Yeah.
how long have people been talking about the debt? It's just like talking about, we were talking about earlier, the 60-40's dead. Well, it's forever dead. It hadn't worked in 10 years,
Yeah.
right? It's the same thing like, well, people have been talking about the debt for decades. And they're like, well, it hadn't blown us up yet, so it's never going to blow us up. It's like, well.
Yeah, Reagan, Bush, and Clinton, that three successive presidents got us back to even par. All three of them were responsible for all the policies and things they did. And it's Republicans and Democrats, right, working together, and they got it. We got to a balanced budget in 2000. It just makes me mad that we've let ourselves get to this point
In the
with our
last
drunk sailor
24,
spending.
25 years.
Yeah, and
I
it's
mean,
crazy. The last thing I'll say on this whole subject, Elon Musk gets a lot of hate and all this stuff, and because he's with the Trump administration, he's trying to cut whatever. I think to myself, what if Barack Obama would have hired Elon Musk to do the exact same thing, to cut government spending, to find areas of where we're overspending? By the way, Barack Obama did create a department for that.
100%. And that's what a lot of people don't talk about. Like there have been other presidents on both sides who have said, hey, we need to cut. We need to decrease the size of government, get out some of the fluff. But when you try to go about it in a way that's going to keep everybody happy,
Exactly
it's
correct.
just, nothing is ever going to get done.
Yeah.
So that's why, like, my communication to everyone I've been talking to is like, just give it a chance. It'll either work or it won't, and they'll have to own it. They probably won't want to own if it doesn't.
They may not own it, but
if it doesn't work. But
yeah.
But there's literally no other way to actually get something done in a 4-year period.
Yeah.
And try to kind of tiptoe into it and slow. You'll look up in 4 years, there'll be another election and nothing will have happened.
It may be just 2 years.
Well,
you think about it. It's probably just a 2-year window that they have to get stuff done.
Yeah.
And I think I think for all Americans, This is why I hate, the discord we have is so rough in America right now, and you can't, if you're on one side, you can't agree with anything on the other side, when in fact, we have a lot of things in common, both sides, right? Most of us all agree on we could come up with a lot of common ground on most everything. I'm talking about most Americans. 90% of Americans can find common ground. And that's the part that's just disappointing to me. It's like, gosh, we've got to rip the Band-Aid off. It's going to hurt. It doesn't matter, but it doesn't have to be political. We just need to fix stuff.
Yeah.
And whether it works
I wish
or not,
Trump and them would come out with, in the last comment, but I wish they'd come out with some of the deregulation stuff.
Which they're going to, but I agree with you. It needs to start.
It's kind of been slow, and I feel like
they've been focusing on the tariffs, I think.
But for businesses, right? I mean, America is still the best place to live, to start a business, to run a business. There's a lot of noise out there right now, but if they could come out here with some of the deregulation, I think that would be a nice little shot in the arm for businesses
I agree.
Across the country.
And taxes.
Yeah. Any parting thoughts or words? A lot going, as I probably say it every single week, but a lot going on, and the markets, market's kind of flat today. It's been bouncing around.
Isn't it nice?
Flat.
Isn't it nice to see a flat market?
Very nice.
Yeah, the last week or two has been solid. Like I said, we've bounced nicely off the lows.
I will say this: with all of the headlines coming out of the White House, we have a Congress. They're really ramping up the budget and this massive piece of legislation that Trump's going to try to get through, which includes extending tax cuts.
Right.
And so, that is largely gone. Nobody talks about it.
I know, and it's huge.
And it's
huge.
It's unbelievably massive. And honestly, it probably impacts more of our clients than tariffs and things like that.
You're right. For anyone out there,
yes,
who listens, sorry.
That was a nice, what do they call it? Pregnant pause? Yeah. Leave us on the edge of our seats.
So there's a podcast out there, All In on DC.
All In on DC?
All In on DC. Maybe we can put a link in our show notes down at the bottom. But there was a Howard Lutnick interview. There's several. Scott Bassett is on there, which was a great one. Yeah, Howard Lutnick. The Lutnick one's like an hour and 45 minutes. You can watch it on YouTube. Yeah. Have you guys seen this?
No, I haven't seen it.
That'd be great. Did you watch it? You should check it out. Not that you're going to agree with everything he says, but I think Lutnick does a good job on this during this interview, laying out what the strategy, like what they're actually trying to accomplish. Because I think
the method behind the madness,
behind that of like, hey, here's everything we're doing, but this is like why we're doing it this way and what we're trying to the end game. And he lays it out there. There's two interviewers, but 2-on-1 interview for an hour and 45 minutes.
That's awesome.
And he gets into the history of some of the tariffs of like where they came from. Right, a lot of these tariffs are in place from post-war eras where we're trying to help countries get back up on their feet or developing nations. And it's like, well, now they're developed and they don't necessarily need the same help, but like no one's gone back and said, okay, we need to like get back on a level playing field. Like you're not rebuilding yourself after World War II or whatever, right? And some of these things go back that far. And so just a lot of really good information. Again, don't go into it thinking, I got to agree with everything he says. Just take it as kind of an informational session, and I think it'll be a good time well spent.
Yeah, he was on this morning, interviewed on. He was interviewed. It was in the, and I don't know which channels covered it, but I was watching him on the channel I watch him on, and it was very fascinating because they go into, it's like not like Trump who kind of makes it. He just creates animosity between. He was out there explaining it in a very good, well-mannered, just kind of like you're talking
just
about.
Matter of fact, here's what we're trying to do. And
it makes sense when we hear it from that, at least in my.
Yeah. So we'll link that in the show notes.
I love that.
Go check that out. I think it'd be good time. Time well spent. So, anyways, any parting thoughts or words? I think we're all a little hungover from yesterday.
Whoa.
Not like because of alcohol.
Speak for yourself there.
I play like
Mr. CEO.
I play like 5 rounds of golf a year, and so like every time I play, I'm like, I am so tired.
It's so tiring.
Like it takes it.
That course is tiring. That's your home course, Lee. I don't know how you do it because it's a lot of hills, and it was even carts off path. There was still a ton of walking.
Yeah.
And that wind. Yeah, it was a tiring day.
I'm sure everybody feels really.
Yeah,
sorry
they
for
feel
us.
really bad for
So,
us.
Pretty much. Cry me a river.
Well,
Yeah.
we appreciate you guys watching and listening. Check out the show notes. Give us a like, subscribe, comment, email us with questions you may have. We really appreciate you guys as always, and we'll see you guys next week.
Have a good week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com.